There we go. Hey everyone, I hope you're all doing well. Hope you're all having brilliant, fantastic, amazing days as always. Welcome back to another video. I hope you're all doing well. Today I'm going to be breaking down, why I've stopped trading Forex and switched to indices. It's something that a few people have been asking me. Why is it that I prefer indices? Why did I start off with Forex? Trade Forex every single day and do lots of it, and then switch over to gold and indices in particular. Compared. So as always, got my right hand, I've got my notepad up here on the right hand side, all with my bullet points. And I'm just going to be going through them. And I want to keep this a short, sweet, and concise video as always. But yeah, let's dive into it. So clearly, for those of you that are newer to trading, Forex pairs are trading off of currencies. So perhaps the dollar and the pound, the pound and the euro and the yen, and indices tend to be companies and for instance markets. So you've got the S&P 500, which is the top 500 firms in America. We've got the US 100, which is the top 100 firms in the US. We've got the Hong Kong 50, we've got the Hong Kong 100, we've got the the German indices, we've got the UK indices, the FTSE 100. We've got lots of them, and they vary. Different brokerages allow you to trade different ones. But for me, I tend to stick with the American economy. Okay, so I'm trading US 100, US 30, okay, and S&P 500. And I specifically focus on those three. Now, why? Why did I switch over from trading GBP, JPY, pretty much every single day, to now trading indices and gold in particular? So a few things. Firstly, the speed of the market. Okay, whilst GBP JPY is one of the fastest Forex pairs there is really to trade, it tends to be one of the most volatile ones. It's one of the most, in quotes, exciting ones to trade. For me, Forex pairs are just a bit too slow. Now that's that's not bragging right or anything like that. It's simply that with my day trading strategy, okay, with me wanting to trade a handful of times each and every day, Forex pairs I wouldn't get enough entries. The market doesn't move fast enough. Okay, so that's the first thing. It also means that I would tend to have to steer towards more either scalping and trying to catch 10, 20 pips off of support and resistance zones, which is what I did do on GBP JPY, and thoroughly enjoyed it and still do it every once in a while. But I would have to do more swing trades. I'd have to try and catch big swing movements. Forex pairs tend to trade off of channels and trend lines and stuff like that. Typically a lot more than they do. Like indices trade a lot more of smart money techniques like order blocks, imbalances, which now suits my style a lot more. And so speed of the market is the first thing. Now, the second thing is indices for me are a lot more predictable off of the general news. Okay, now it's very, very easy to take a macroeconomic picture view of the American economy. Okay, to see if American economy is doing well. Okay, or bad. Check out Apple. Check out their latest releases. Check out their revenue reports. Okay. Check out the unemployment rates in America. Check out interest rates, inflation. Taking macroeconomic picture view stuff can really, really sway how you believe the American economy is going to do. Okay, now of course as well, the American economy, if you zoom out to the weekly time frame, okay, is of course gone upwards. Okay, it's gone upwards pretty much every single year since however long ago. It's Warren Buffett's favorite tactic is to just buy and buy and buy into the S&P 500, and all of his basic rules of thumb for investing are buy the S&P 500 as much as you can and hold it. And so typically when buying S&P 500 or US 100 or US 30, you've got a pretty good natural bias that if you hold it, it's going to go upwards. Now, of course, we've seen a recent dip as of the moment, with the American economy and fear and all that sort of stuff, and crypto's been crashing, etc., etc. But as a general rule of thumb, the American economy has been strong and has gone upwards. So it's quite a good thing to trade, with that natural bias. So for me, indices are predictable off more general news. Okay, and we can take into account where we roughly think everything's going to go off of each news high impact news release. With strategies that I've developed, okay, with other strategies, with order block strategies, imbalance strategies, with flow, Wyckoff, all of these other ones that are out there now that are popping up for retail traders. What it means is that you can get really, really good risk to reward ratios, which is my next point. You get lots of opportunities within the day because you're taking, there's a lot of liquidity candles that you can tap into, okay, and play off of. But you can get really, really good risk to reward ratio trades, okay. If it's swiping into liquidity and then suddenly moves past that and makes your trade invalid, you're gonna have quite a tight stop loss, okay, and you can have quite large TPs. So your risk to reward ratios can be really, really good. And from what I found is that the Forex pairs risk to reward ratios for me weren't anywhere near as good. And if I wanted to make them good, I didn't have as great success. Okay. And at the same time, if I wanted to have really good, risk to reward ratios, I'd either have to extend my TP massively, which means that I'm pretty much swing trading now, which of course I've got more time in the day and I want to be more active within the space rather than holding positions for weeks and months. So for me, that's why, with a few bullet point reasons why I've, not stopped, but just slowed down my Forex trading and, spent a lot more time trading indices and gold, because gold, factors into quite a lot of that as well in terms of smart money, moves, liquidity candles as well. And, gold and of course, indices, pretty much move alternating each other, because of course gold is seen as a safe haven asset. So if the American economy is doing bad, gold should be going up, vice versa. So of course, there's a few other factors as well, and you need to think about it yourself whether you like trading indices. Indices tend to take and need more capital as well. So hence why I started off with FX, because you can trade it on a small amount. With most brokerages, you need significantly larger capital to be able to trade indices and put in a position size. So yeah, ultimately, moving across to indices has been something that's happened in the last, year, but clearly the first, year and a bit, I was, trading Forex, trading FX. So yeah, ultimately, I hope, this video has, as always, given a little bit of insight into, my decision, into, trading a lot more indices. And if you like the video, feel free to subscribe, feel free to like, and, drop down your thoughts down below in comments on what you trade. I'd be interested to hear. So yeah, ultimately, see you in the next video. As always, all of the links to the group chats are going to be down below. Discord, Telegram, Facebook, TikTok, Instagram, the rest. Feel free to message me as well if you've got any questions, and I look forward to seeing you in the next video. Have a great day. Bye for now.